Did you know that Keeneland had a record-breaking horse sale last fall? Over a $500 million was spent in a single September auction. Why? Well, I believe the answer lies in a change that the One Big Beautiful Bill brought on, specifically around business owners. So if you own a business, if you're self-employed, or file as a sole proprietor, you're going to want to listen to some of these significant changes that were made. So let's jump right in. 100% bonus depreciation is back. And I think this could be the underlying reason for the record sales at Keeneland last fall. Because when somebody drops $1 million on a thoroughbred yearling, they're not just buying a horse, buying a tax deduction. And now that deduction is 100% depreciable in year one. 100% bonus depreciation has been restored and made permanent for qualified property placed in service on or after January 20th of 2025. And here's how bad it has gotten under the old rules, which started in 2017. Bonus depreciation was already down to 40% in 2025 and was headed to zero by 2027. This has been fully restored to 100%. What this means in plain terms: if you buy eligible equipment, machinery, or qualifying property for your business, you can deduct the full cost in the year you put it in service, rather than spreading it out over years of depreciation. This applies to a wide range of business assets, not just horses. Vehicles used for business, equipment, machinery, certain building improvements, software, and more. The planning question is this: do you want to take the full deduction this year or spread it out over the next couple years based off of where your income is headed? That's a real strategic decision, not a default. And unlike Section 179, which we'll cover next, bonus depreciation can actually create a business loss, which opens up additional planning options. Section 179 got a major expansion. Section 179 and bonus depreciation both let you expense assets immediately, but they work different, and the limits just got significantly larger on Section 179. The limit has doubled from $1.25 million to $2.5 million per year. The phase-out threshold has also increased from $3.13 million to $4 million. That means more businesses can use it before it starts to disappear. The big difference from bonus depreciation and Section 179 is Section 179 is limited to your taxable income. You cannot use it to create a loss. You can only deduct up to what you've earned. That makes the order in which you apply these two tools a real planning conversation. Bonus depreciation goes first if you want to potentially create a loss carry forward. Section 179 is the tool if you want to shelter income you already have. For most small and mid-sized businesses, the practical takeaway is simple. You got more room to write off equipment and asset purchases in the year you make them, without waiting years for depreciation to work its way through. And finally, the QBI deduction is now permanent. This one quietly matters for a lot of business owners, and most of them don't know it almost disappeared. The Qualified Business Income Deduction, or the QBI deduction, was established under the 2017 tax law. It allowed qualifying business owners to deduct 20% of their net business income. It was set to expire at the end of 2025. It is now permanent. If you are a sole proprietor on an S Corp, partnership, or LLC taxed as a pass-through, this deduction applies to you. The phase-out for service-based businesses, what the IRS calls specified service trades or businesses, still applies at higher income levels. For married filers, it starts phasing out at $394,000 in taxable income. That's you. You need to be working with someone who knows how to navigate this. The bill also widened the phase-in range, which gives more mid-income business owners access to the full deduction than under the prior rules. Now, if you've been taking this deduction, didn't realize it was expiring, now you know it's locked in. If you weren't taking it and own a qualifying business, it's a conversation worth having with your CPA. So we've got three different tools: bonus depreciation, Section 179, and the QBI deduction. But one common theme: The tax code is actually rewarding business owners who are intentional about how and when they deploy capital. Whether you own a business, are self-employed, or have been thinking about starting something, I'd be glad and honored to sit down with you and walk you through what these changes mean for your specific situation. Please click the link below to schedule a call to get this process started. And next time, we're turning towards the family, covering the changes to child tax credits, child care credits, and adoption credits. We'll see you then.